Hello and welcome to the channel. Today we're going to be talking about the different types of investment accounts that you need to know about. And just as a disclaimer, as always, I am not a financial advisor, so do your own research whenever it comes to finances and investment. So I'm going to go over some of the Canadian investment accounts that you need to know about. The first one is the TFSA, which is the tax-free savings account. Your RRSP, which is your registered retirement savings plan, and your FHSA, which is your first home savings account. Things about your TFSA. Your TFSA has a contribution limit of $7,000 a year, but every year from when you turn 18 or 19 in some provinces, that the unused amount rolls over. So I'm currently 23, so I can max out my TFSA at $35,000, even though I only started investing this year. And come January again, I can contribute another $7,000. And what you should be investing in your TFSA is broad market ETFs that follow some of the Fortune 500 companies. Like an amazing index is the S&P 500. A good ETF that follows that is VU. QQQ is also another amazing option. Even VTI is a pretty good option, which is something I have a good chunk of money in. And those are some of the safest broad market ETFs you can invest in for long-term growth. Historically, both have given roughly a 10% return. VTI is up. Last year was a pretty good one for VTI. It was up almost 18% return last year, which is amazing. And all the profit you make is within a TFSA is completely untaxable, and you still earn dividends as well. It's amazing. The TFSA is an amazing account. It is your first step. It is the first account you should open when you start thinking about investing. The next account is your RRSP. Your contribution limit is similar to the TFSA. Unused amount rolls over year by year, but the maximum contribution yearly on your RRSP is 18% of the previous year's income, and that's not counting any unused contribution room. So if you haven't put anything in the RSP for years, and you contribute above that 18% cap and not have to worry about it. But there are penalties if you max out your RSP and you put more than that 18% after you've used all your unused amount. They give you about a $2,000 error before they start giving you penalties. So it's something to be aware of. Another amazing thing about an RSP is you can write off your contributions from your taxes. Like, you can lower your taxable income, which is something you can't do with your TFSA. So it's amazing. It's amazing. You don't get taxed as much. It's great. But withdrawals from your RSP are taxable as income. So if you withdraw money early from your RSP, that money, you will be taxed, and even it's taxable income. So you can write it off in your taxes when you contribute to it, but when you withdraw, then it gets taxed. And one thing, I think this is very, very important. If you plan to move out of Canada in the future, I would not recommend contributing to your RSP at all, because they can and will double tax you when you try to withdraw from RSP, and they will tax you like an exit tax for leaving the country as well. If you plan to move out of Canada in the future, I would not put any money into your RSP. It's just not worth it. You're going to be losing a lot of money when you try to withdraw that money. It's just not worth it. And then the last one we'll talk about for the Canadian accounts are the FHSA, which is your first home savings account. So the contribution limit for this account is actually $8,000 annually, but it only has a $40,000 lifetime limit. So you can only put $40,000 in your FHSA. Contributions can also be written off on your taxes, just like the RRSP. And withdrawals towards buying a house are tax-free. So if you pull it out to do something other than buy a house, it's taxable income. But if you pull it out to put down on a down payment on a house, it's tax-free. A lot of people that put money in the FHSA aren't actually planning to buy a house. It's just another investment account where you can grow your income once you max out other accounts. This is one of the last on the list. Once you max out your RRSP, you max out your FHSA. And you don't have to worry about it because after 15 years, the money inside your FHSA will be rolled over to your RRSP if you don't buy a house with that money by then. Okay, next is the US accounts. Just be aware, I reside in Canada. I am not super well versed in the investment space with the US, but these are the basic investment accounts. One of the big ones you hear a lot is the Roth IRA. Contribution limit for 2026 is $7,500. It was $7,000 in previous years. And just like the TFSA, the contribution amount rolls over from the previous years. But with it increasing like that, every year you'll be able to put an extra 500 in, but the previous years before the increase, it'll still only be 7,000. And contributions can be withdrawn at any time, non-tax, but any earnings made within your Roth IRA are taxable when you withdraw, and you can be given a penalty. Next one is a 401k. This is another one you hear a lot in the US. This is an employer-sponsored retirement plan. It's similar to the Roth IRA with the same contribution limits, but any withdrawals before the age of 59 are taxable, and you will be given a penalty. It's similar to the RRSP in Canada. It's your retirement plan. And then the last one, this one is not specific to the US. This is the last step once you max out every single account you can. The last step is to open up an individual brokerage account. And it has no contribution limits. You can throw as much money into it as you want. There's no penalty on withdrawals, but it is taxable on capital gains and dividends. This one I'll have, again, this is end game. Once you max out every other account you can, then you open up a brokerage account. And this is the end game. I will have an entire video dedicated just to an individual brokerage account, what you do with your brokerage account once you get to this stage. But again, you're talking 10, 15, 20 years down the line when you start thinking about opening up a brokerage account, unless you have an insane amount of capital now that you can throw in to max out all your accounts. But that is it. That is the basics of types of investment accounts you need to know about in Canada. And I tried my best with doing a little bit more research into the investment accounts in the States. I know the information's a little bit more lacking in that regard, but that's all I got for you guys. I hope you learned something here, and I hope you gained a little bit more knowledge that you didn't have before. And thank you.